Hi, this is Samer Halal, Wealth Advisor from Cleveland, Ohio. Welcome back to part 3 of my budgeting series. In the last video, Understanding Your Paycheck, we took an in-depth look into the income of employees otherwise labeled as W-2 income. In this video, I will cover 1099, retirement, rental, and investment incomes. So let's dive right in. 1099 income is typically reserved to those generating self-employment incomes, such as independent contractors, freelancers, consultants, etc. The individuals in this group tend to be self-employed and are responsible for their own income-related taxes. Self-employed individuals are usually able to deduct most of their business-related expenses before arriving at their taxable income. They also have the ability to establish their own employer-sponsored benefits such as retirement plans, health, dental, and vision insurances. They are typically advised to file their Medicare and Social Security taxes on a regular basis. This group must pay the 6.2% Social Security tax that usually the employee pays, as well as the 6.2% Social Security tax the employer matches. Effectively, they are paying 12.4% in Social Security taxes on the first $147,000 worth of income. Rental income. Rental income is typically generated when an owner rents out some sort of an asset and generates regular income from it. Examples would be residential as well as commercial rental properties, Airbnb arrangements, automobile rentals, etc. This rental income is taxable after the appropriate amounts of expenses and depreciations have been subtracted from the income. Rental income in most cases is not considered earned income and as such will not be subject to Medicare and Social Security taxes. But there are instances where it will be subject to both. Please check with your tax professional to determine your tax status. Rental income is the first type of passive income we are covering today. Another would be retirement income. So this is the type of income one would receive after they retire from a lifetime of work. This typically includes two types: Social Security income and pension income. Social Security income is what most Americans qualify for from the Social Security Administration after they reach their full retirement age. The full retirement age was raised several years ago, and many of you who continue to work will not reach it until the age of 67. This obviously can be changed again in the future if the government enacts new laws. To qualify for Social Security income, you or your spouse needed to have contributed into the Social Security fund for a minimum of 40 quarters, or 10 years, and have reached your full retirement age. The current laws allow those who qualify to start collecting Social Security income as early as age 62, but they will be collecting at a reduced amount. The Social Security Administration will reward you and increase your benefits by an annual multiplier of 8% for every year you defer from your full retirement age to age 70. It is strongly recommended that you check with your tax professional and/or your financial advisor before filing to collect Social Security income. The other type of retirement income is pension income. This is an income that is typically paid by the employer to their retired workers for the balance of their lives. Pension plans, also known as defined benefit plans, used to be the norm when it came to employer-sponsored retirement benefits. But about 40 to 50 years ago, many large companies started to realize that they did not want to carry the longevity risk of their retirees. So they started phasing out their pension plans and replacing it with defined contribution plans, such as the infamous 401k plan. You may be receiving some sort of pension income yourself, but odds are your children or grandchildren will be completely phased out of any type of pension income. The third type of passive income we will cover today is investment income. This is the type of income that one will receive from their investments. Examples will be taxable interest received from any savings accounts, money markets, or CDs held at your bank. Taxable interest received from your corporate or treasury bonds held in an investment account with your financial advisor. Taxable interest from bonds, CDs, money markets, savings accounts are all taxed as income. Tax-free interest. This is typically derived from any municipal bonds you hold in your investment account. Those can be in the form of individual municipal bonds or mutual funds or ETFs of municipal bonds. Dividends. Dividend income is derived from individual stocks, mutual funds, or ETFs, and other dividends-paying investments held with your investment advisor. Long-term dividends may be taxed at a reduced rate depending on your holding period and your individual income tax bracket. Capital gains. Capital gains are generally occur when you sell an asset at a higher price from what you purchased it for. This asset can be a stock, a mutual fund, an ETF, a piece of property, a business, etc. The tax rate is determined by your holding period, your income tax rate, any potential depreciation or deferral you qualify for, etc., etc. Ask a tax professional as to what tax rates apply in your case. Investment income may also include income that many will receive after retirement. This type of income can come from annuities, 401k or retirement plan distributions, traditional IRA distributions, required minimum distributions, etc. I hope I did a decent job in describing where the potential types of income come from. I am certainly open to answering any of your questions that you may have. Starting with the next video, we will be covering how our incomes are being spent and provide some guidelines to how you can organize, understand, and prioritize your different expenses. See you all next time.